Let's get started with the positioning view. Now, this month's stance expressed as a line item tilts. The dominant driver of this issue is the feature thesis that middle powers are converting geopolitical optionality into financial positioning. And the cleanest expression of that conversion, official sector gold, selective middle power local currency debt, critical minerals leverage carries the overweights. The data column out here marks the change versus the prior issue. In the snapshot out here, you can see when we're talking about gold, it is reserve fragmentation bed, middle power accumulation is structural and not tactical out here. When we are talking about the DM equities in terms of Europe and in terms of US, when we're talking about US, it is AI stack dispersion persisting, with discipline at the index level and selectivity by layer. However, the assets that are actually repricing in mid-2026 sit in the third block. The power is declining to pick a side. Across the Gulf, Europe, and the ASEAN-Brazil axis, the common behavior is not alignment but hedging. Each preserves optionality across security, energy, settlement, and supply chain dependence rather than committing to one pole. The analytical payoff is that this hedging is no longer purely diplomatic, it is converting into financial positioning, and that conversion is the trade. Hello everyone, welcome back to our channel and welcome back to this video. This video is going to be a part of our series of global allocation briefs wherein we do the monthly cross-asset synthesis. This is our second issue in the series and this is a paid feature and hope you enjoyed the last version also. Today for this monthly series, we're going to focus on the middle power hedge. What we're going to do essentially is we're going to synthesize all the fault lines middle power cluster into a single allocator framework for you. Now, before we move forward into this issue, let's start with an executive summary from our last issue. In our last issue, we had argued that the AI trade is a category error. This stack splits into 4 capital flow layers: the training compute, the inference and serving, the agent application layer, and data and distribution. Each with its own incumbents at risk, financing template, and multiple trajectory. The positioning trade that we had stressed on was that to stop treating AI as a single equity beta and instead map portfolio exposure layer by layer, leaning towards the layers where capital structure, not just narrative, was repricing. This issue carries the lens forward from the capital stack to the multipolar order and asks a parallel question. Where is the geopolitical optionality quietly converting into financial positioning? Let's get started with the positioning view. Now, this month's stance expressed as a line item tilts. The dominant driver of this issue is the feature thesis that middle powers are converting geopolitical optionality into financial positioning. And the cleanest expression of that conversion, official sector gold, selective middle power local currency debt, critical minerals leverage carries the overweights. The data column out here marks the change versus the prior issue. In the snapshot out here, you can see when we're talking about gold, it is reserve fragmentation bed, middle power accumulation is structural and not tactical out here. When we are talking about the DM equities in terms of Europe and in terms of US, when we're talking about US, it is AI stack dispersion persisting, with discipline at the index level and selectivity by layer. However, when we're talking about Europe, excluding UK, we are seeing strategic autonomy and defense capex free rate happening. When we're talking about currency, we can see that the reserve share erosion is a slow-moving. Near term, the dollar rate is bound, but Japan repatriation is the fast switch trail out here. And in terms of credit, we have already discussed this in multiple videos, the private credit and BDC, redemption gate, and PIK accumulation overlay is happening, and NAV marks are lagging the reality. When we are talking about the commodities, we have choke point risk premium retained as the Gulf hedge. And when we are talking about the minerals and the miners, we are seeing supply chain concentration handing the middle power producers the pricing power out here. When we are talking about in terms of digital assets, we are seeing regulated pulp market structure forming and venue integrity risk capsizing. And when we are talking in terms of the FX hedge, we are seeing the Japanese upside. We have seen cheap optionality on Japan repatriation. We are also seeing the AI unwind trail, which is also doubling as a US hedge. With this snapshot, let's dive deeper into the middle power hedge out here. We have done a lot of videos covering the middle power hedge throughout the month. Do check out those videos also. Finally, what we would like to wrap this up with is that the bipolar US-China frame is where most allocator commentary is living these days. However, the assets that are actually repricing in mid-2026 sit in the third block. The power is declining to pick a side. Across the Gulf, Europe, and the ASEAN-Brazil axis, the common behavior is not alignment but hedging. Each preserves optionality across security, energy, settlement, and supply chain dependence rather than committing to one pole. The analytical payoff is that this hedging is no longer purely diplomatic, it is converting into financial positioning, and that conversion is the trade. Now, the synthesis that cannot be assembled as piecemeal is the mechanism itself, because the middle power hedging shows up as four slow but compounding flows. A structural bid under gold and non-dollar reserves, a re-rate of middle power local currency assets that carry the hedge, a concentration of pricing power in the choke point that those powers control, and a multi-year relocation of supply chain FDI. The feature gives the map and the rest of the issue positions against it. Let's talk about the hedge ladder out here. Now, for each power, three coordinates: the axis that it hedges on, the expression that carries the hedge into the markets, and the tripwire, that is the catalyst that would force commitment and collapse the optionality premium that the hedge currently earns. When we are talking about the middle powers, you have the Gulf, that is the GCC, Europe, and the ASEAN and Brazil. And when we are talking about the axis, it is energy plus reserves for the Gulf. It is security and strategic autonomy versus structural dependence for Europe. And when we are talking about the ASEAN and Brazil, it is supply chain plus critical minerals plus BRICS settlement. When we are talking about expression that is tradable, for the Gulf, it is the oil curve, sovereign deployment, gold accumulation, and peg stability. When we are talking about Europe, in terms of the expression that is tradable, you have defense equities, euro reserve share, and bond spreads. And when we are talking about ASEAN and Brazil axis, you have the ASEAN local debt, the FDI flows, mineral names, and the AG complex. And let's also discuss the tripwire to finish the structure and the framework. When we are talking in terms of Gulf, you have the UAE OPEC exit and a forced settlement of the currency choice. Then when you're talking in terms of Europe, you have a US guarantee credibility shock forcing real autonomy spend. Finally, in terms of the ASEAN and Brazil, you have the secondary sanctions pressure and a live BRICS settlement rail. Let's expand this further to understand the details. When we are talking about the Gulf hedges on two axes at once: the energy pricing power and the currency in which its reserves and the trade ultimately settle. The expression is the most liquid of the three: the oil curve, the scale and the direction of the sovereign wealth deployment, steady official gold accumulation, and credibility of the dollar pegs. The optionality is real, a Gulf that keeps both a dollar peg and a growing gold book, and a widening menu of settlement counterparties is paying the right to choose the ladder. The tripwire is the UAE OPEC exit decision or a forced settlement currency choice. Either collapses the ambiguity and reprices the peg, the curve, and the Gulf exposed EM in one move. In terms of Europe, the Europe's hedge is the inverse of Gulf's. It is a long structural dependence on US security guarantee, dollar plumbing, and the external energy, and it is now only buying the option to be autonomous. The expression is the defense industrial re-rate, the slow drift in euro reserve share, and the behavior of the bond spreads as the fiscal capacity is redirected towards autonomy spread. The tripwire is a credibility shock to the US guarantee that forces the option to be exercised, at which point the defense capex stops being a sentiment trade and becomes a multi-year fiscal commitment, with the funding question landing on the bonds and the periphery. Now, the ASEAN-Brazil axis is the clearest middle power as a beneficiary case. Its hedges the supply chain and settlement optionality, capturing China's manufacturing reallocation, sitting on critical mineral and agricultural supply that the rest of the system needs, and keeping a foot in the BRICS settlement experiments without abandoning the dollar markets. The expression runs through the BRL, ASEAN local currency debt, inbound FDI, mineral and AG names. The tripwire out here, though, cuts both ways. Secondary sanctions pressure that forces a side, or a live BRICS settlement trail that suddenly makes the non-dollar option cheaper to use. And if we widen the lens towards Latin America, we see that the Brazil leg reads better as the leading edge of a broader Latin American re-rate than a single country bet. A regional right with political shift is compounding with incremental corporate governance reform and the growth of domestic pension pools that deepen the local bid for assets, still screening cheap. The corroboration worth flagging is external and arrives from different starting point. Latin America is a multi-year local asset re-rating on three drivers. Convergence on the trade from outside the framework raises conviction in the expression without changing it. And it also sharpens the tripwire reading. Each market that resolves its political risk to the upside removes a discount that the regional basket has been carrying. So when we do a cross-asset read-through, we can see that it is stacked and the three hedges point in the same direction in a handful of trade. Gold gets a persistent official sector bid that is price insensitive by design, and at the same time, select middle power local currency debt offers carry, plus a currency re-rate as the hedge is monetized. Critical minerals and the producers that control them gain pricing power as the supply concentrates. The marginal erosion in the USD reserve share is slow but directional. And the choke point risk premium, energy through the Gulf, minerals through ASEAN, stays embedded rather than fading. None of these is a fast trade, but all of them are compounding ones. Now, this snapshot gives you the geopolitical risk monitor. We have live situations read through a cross-asset transmission lens, each tagged with its own most exposed assets and the catalyst to watch out for the next 30 days. There are two entries that feature the tripwires carried here as standing watch items. We have five major situations out here. We have the Hormuz Gulf energy residual risk. We have the UAE OPEC exit decision watch, the Europe security guarantee credibility, the Japan and Bank of Japan normalization, and super long JGB stress. And finally, the CME Kalshi for Petrol Futures litigation. So when we talk about the structural risk overlay, we have slow-moving risks that shape the positioning over quarters and not weeks. In this issue, we have upgraded reserve fragmentation. It is the spine of the feature and it leads to the register. Essentially, this snapshot gives you the structural overlay risk with reserve fragmentation at the top, repatriation flows, the Japan reversal second, the private credit and the BTC strength third, the distribution wealth stack consolidation fourth, and the AI capital stack circularity fifth. And finally, let's wrap up this month's global allocation brief with recalibration. This is more of our accountability section. The prior issue specific calls are marked against what actually happened. Our Jones feature wants the AI capital stack map, the argument that the four layers are distinct capital trades. The snapshot here shows the marks and assesses each layer's call. When we were talking about the training compute, we had said that scarcity will be priced and we favor the constrained layer. What actually happened is compute scarcity did hold and the pricing power persisted at the constrained layer. When we are talking about inference, we had said the serving margin compression risk is there and the underweight bias is also there. What actually happened is serving margins did come under pressure as capacity came online. When we are talking about the agent and the application layer, we had said that the monetization is unproven and caution is required. And what actually happened out here is that monetization is still uneven, dispersion widened across the names. And finally, the last layer, which is about the data and distribution, we said that the incumbency is got to be re-rated and it is underappreciated. However, what really happened is that the re-rate is slower than argued. And what happened is that the incumbency premium is intact, but it is still unrepriced. We were definitely early on this. Now that's all that we have for you in this month's edition of Global Allocation Brief. Hope you've enjoyed this edition. Do check out our previous edition also, and do check out our detailed videos that we keep doing on Capital Insight series, that is Fundamentals to the Noise, here at Punjab Capital Research. That's all for this video. Stay tuned in for our next one.